strict from their charter that they cannot raise total shares more than worth of $1 billion, right? So for example, and also it's not like that they're going to be issuing 1 billion at once. So they issue, like for example, $1 million of funds, and then after 4 to 5 years again 5 million, it's like that, and 50 million, it's like that. So whatsoever they issued the shares and received the capital, we call that contributed capital or paid in capital, the amount of equity that shareholders have already contributed. So this includes the stocks or shares and any additional previously issued stock. Retained earning means that the earnings that company earned but retained and not share with its a shareholder in the form of dividend. They retained in the business. So these are the earnings through profitable operations. So they reduced by the dividend declared, which means they are not given as a form of dividend. They kept it in the business for future use. So exhibit 10.3, it shows the sample of stock certificate of depot incorporation. See, the par value, company name is written, stockholder name is written here, right? Issued to William, right? And the number of shares as well, how many units of shares they have purchased. Okay, so this is just an example of how the what the per share or shareholder equity look like. Okay, classes of stock. One is called common stock and one is called preferred stock. So common stock is a basic form of the stock. So the common stock has all four rights, which is voting, preemptive right, dividend, and transfer of ownership, right? And it also more riskier, because if there is a loss, common stock people, they have to share the loss as well. Preferred stock, it is kind of like a bonds, but the treatment is like it's an equity. It means they share the profit but they don't share the loss, but they share fixed kind of profit. So the advantage one is that they receive dividend first and also receive asset first in liquidation as well. So shareholders earn a fixed dividend. If there is more profit, even then they are given the fixed rate. If even there is a loss, even then they are given the fixed rate. So few corporations issue this one. And why there is a need for preferred stock? Because maybe the company is new, so they want to make sure that the public, they're going to invest with themselves. They buy the shares in order to give them some kind of like hope that the company will give them at least some fixed dividend, and normally they are convertible to some other stocks as well, which means after some time they are convertible to common stocks when the confidence in investors rises. Okay, this company is doing well, okay, then let's share its profit as well and loss as well. Okay, so classes of stocks and comparison with the long-term debt, for example the bonds payable. So obligation to repay the principal, no. In that, yes, we have to, the company will be company have to pay back the amount of principal, the amount of loan that it asks from the public. Dividend and interest on the profit or okay, tax purposes. So dividend interest, it is tax deductible, it is tax deductible, it is tax deductible. Sorry, the dividend are not tax deductible, but interest is tax deductible. What does it mean? It means if you see the income statement, it is sales minus cost of goods sold. We have gross profit, we minus admin, selling expenses. Answer is operating profit, and then minus interest, right? And then minus taxes, we have net income, and then after that we minus the dividend. right? So dividend is not tax deductible. See, tax is applied on after deducting the interest. So you receive some kind of benefit. More interest means less taxes because there's going to be less amount left here for taxes, right? So tax deductible is dividend are not tax deductible, but interest is tax deductible. Obligation to pay dividend and interest. The obligation is that the common stock dividend is given after declaration. Preferred stock is also after declaration, but the interest is not, in the hands of like shareholders declaration. If the date comes, you have to pay that, and it's a fixed rate. Okay, let's talk about of the learning objective. So account for issuance of stock. So we have an example here. It is pretty basic one. I just want you to pause the video and then do it together. So Home Depot needs to raise $100 million through issuance of stock. Suppose they issued the stock and each stock per share value is 10. The entry for issuance of 10 million shares would be at par. At par, the same concept is that we applied in our bonds payable at like premium and discount and par. It is the same. So the original price of the per share is 10. So they need to raise how much? 100 million. So 100 million divided by 10. Answer is 10 million shares. So entry would be, so they already issued. So when they issue, they pay the ownership, they receive cash. 100 million cash to common stock, right? Now let's talk about different variation. What if the common stock is issued above par, which means on premium? So that logic also applies here as well. So but with different name, we call this premium above par. Okay, so let's pause this video here, read all this illustration, and then we solve it together. Okay, so company need to raise $100 million. Suppose the Home Depot Corporation, they issue the stock and the par value is 0.05, right? So it means the one share par value is $0.05. The entry for issuance of 10 million shares at 10 per share. What does it mean? When they said that the par value is 0.05, it means what is the value of the shares? 10 million multiplied by 0.05. So this is the value of the shares, and above that value, they need how much they get? 10 million shares, and the market value is 10. The par value is 0.05. So the additional paid in capital, we call that this paid in capital. So common stock or this is like a premium, right? So entry would be cash, they receive 100 million. Common stock, against that cash, how much the common stock is? 0.05 multiplied by 10 million, and the excess amount is paid in capital. See, amount that in excess of the common stock, we call this paid in capital. So how it is